I'm pleased to be joined with Austan Goolsbee here, the president's chief economist. We saw some slowing in economic growth, 1.8. Expectations were at 2%. What's behind the slowdown?
Well, the biggest thing behind the slowdown, it was an expected slowdown. And the biggest driver was a reduction in government spending at the federal level, a big negative from defense spending. So you saw Bernanke say yesterday, and you see the private forecasters saying they believe that to be a transitory slowdown. So nobody likes a growth slowdown. We got to have faster, but 2011 and 2012 still looking fairly positive.
How much do you think the cost of oil, the increase in oil, affected the first quarter, and do you expect to see more in the second quarter? Sometimes you see a lag with the price of oil.
We've been trying to analyze that because clearly that's been hurting consumers. I think the fact that consumer spending did not fall much, actually came in well better than was expected at 2.7% growth, was a sign that the payroll tax cut of December maybe offset in some significant way whatever was coming from oil. So that was at least a positive. It did not look like oil hitting consumers was the thing driving the slowdown.
And for the second quarter, the next quarter, do you expect industrial output to be affected by any of this?
Well, you know, we continue to monitor and try to see that. Overall, since the 70s, when there were big GDP effects of oil prices, American business has gotten a lot less energy intensive. So up or down, oil prices tend to have less impact on GDP growth than they did in the older days. In this business confidence, if you thought that had been hit by oil prices, you would have thought investment in equipment and software would have gone down. But in fact, that also came in a little better than expected. So that consumer spending and investment remained relatively strong. Was a good sign, but you know we got to keep an eye on the oil prices for sure.
Another data point we had today: jobless claims up, highest number I believe in 3 months. Do you see a relationship between the jobless claims applications and then the monthly unemployment number? Should we be bracing for something a little disappointing?
Well, we don't. For sure, you don't want to make too much out of any 1 month of UI claims because that's a highly variable statistic. You also have the issue that Easter's a holiday that moves around, so there is a seasonal adjustment problem usually in these weeks. We've had pretty sustained job market growth, adding jobs, and the last 2 months have been very strong, despite the slowdown of GDP over that same period. There can be blips up and down. You shouldn't make too much negative until you see a longer trend than a week or two, for sure. But we got to get the growth rate up. There's still way too many people out of work, and we got to get that engine revved back up.
Suspect you watched Mr. Bernanke's performance yesterday. What'd you think, and what'd you think about him talking about QE2 ending at June? Do you think it will be too abrupt? Any concern there?
Well, you know, I'm not going to weigh in on their monetary policy decisions. They're independent. I thought Chairman Bernanke did a very effective job explaining what they were doing and where they saw the economy. I thought it was very clear. Hopefully he's not going to put all the rest of us out of business.
I know you don't talk about the dollar as well, but the chairman seemed to indicate that there is some relationship between the dollar and the price of oil. Are you seeing something similar, particularly with gas prices, that so many consumers are concerned about?
Well, you know, there are a lot of effects. Even Chairman Bernanke said the U.S. Treasury speaks for the government on dollar policy, and I'm going to reiterate that for the CEA. There are some people who say that, I mean, it's clear the dollar has gone down and oil prices have gone up. There are some who see some tie to that because the dollar price of oil would go up as the dollar went down, and the oil producers might demand higher compensation in the dollar currency. On the other hand, the flight to quality that occurred during the downturn and that flight back to normal would look like the dollar going down and the price of oil going up, but that wouldn't mean that one was causing the other. So I think we want to be a little more circumspect than just pointing the finger.
And then what about the chairman's concerns about the S&P and call for action?
Look, there's a call for action to address long-term deficit issues and bring ourselves in fiscal balance. I think the president's pretty pretty committed to that. I thought the judgment in the S&P, which was reaffirming the AAA rating and was just saying something about their opinion about politics in the years to come. You know, I don't know that the S&P has any special expertise on American politics more than you do or more than anybody else does. So that was why I thought, look, it's a data point, but don't make overly much out of it.
Okay, thanks, Austin. As you heard, Austin there, we'll leave politics to the politicians, the prognosticators, the economy to Chairman Bernanke, and we'll leave his brief to him.